Hi, this is African Mission Healthcare's financial management train the trainer videos, and this is video number 5. In video number 4, we talked about the income statement, which is meant to look at a period of time and understand the revenues and the expenses over that period. The balance sheet is at a moment in time, so as of December 31st, 2018. And it is meant to summarize the assets and the liabilities and ultimately the equity of the institution for which it's prepared. An asset is really what we own, and some assets are tangible, so you can touch them, and some assets are not tangible. For example, the goodwill of the community or the brand of the institution are certainly valuable, but you can't touch them. Liabilities, on the other hand, are kind of what we owe, and liabilities can include things like short-term loans, but also long-term obligations and things like that. It could be also what we owe our employees. So if we have some payroll that's due to our employees, that's clearly a liability of the institution. And equity is the difference between the two. So if you take your assets and you subtract out your liabilities, you ultimately have your equity, and that's the net worth of the institution. So we'll talk about these things in a bit more detail. When we think about assets, we tend to think about current assets and other assets. Current assets are generally things that are convertible to cash within 1 year. So cash is, of course, a current asset. And accounts receivable is often considered a current asset. So if a patient owes you, 3,000 shillings for their care, that's a receivable, and typically we expect receivables to be paid in 30 or 60 or 90 days if they're going to be paid at all, and therefore they kind of meet the criteria as a current asset. And then there's other assets. Example of that would be pledges and contributions receivable, but it would also be things such as the building that you're working in. Perhaps the institution you work for actually owns the land and owns the building that the institution is based on. Those would, of course, be other assets, but you couldn't necessarily count on them being turned into a current asset within the course of a year. Liabilities also are broken out into this structure of current liabilities, those that are due to be paid within a year, and other liabilities, things that are due to be paid over a longer period of time. And accounts payable is an example. You may owe some money to a vendor that lives near you for certain goods or services that they provided, and that would be a current liability because it's expected to be paid within a relatively short period of time. There's also liabilities like provision for uncollected receivables. So, let's say you're expecting to get paid money from your patients, but some of it will not be paid. You can set up a liability as an accounting tool to basically say, look, even though we're supposed to receive 10,000 shillings in revenue, we know that we're probably going to have to discharge about 2,000 of those shillings and set up a provision for the uncollected receivables. And then other liabilities, can be long-term in nature, and long-term loans are the primary thing that we talk about in this category. So an interesting discussion question is, what happens when your liabilities are greater than your assets? Now, of course, that's what we call bankruptcy, right? That's a technical state of bankruptcy, but perhaps not an operational state of bankruptcy. So there are some institutions and certainly some households and families and communities that have more liabilities than they have assets, and they can continue to function, but typically the people to whom the liabilities are owed have legal recourse, and it's their legal recourse that typically would make an institution go technically bankrupt or legally bankrupt, as an example. But in general, we try to build our asset base and have our assets be substantially larger than our liabilities, and therefore build equity. So a balance sheet is a really good statement to get a sense of the health of the institution very, very quickly. If they have some cushion, they have assets larger than liabilities. If they are on the edge or on the brink, liabilities are usually pretty close to assets in raw amounts, and there's very little equity. So equity can be thought of as a shock absorber for an institution. Now, the current ratio is a tool that we use to measure the amount of current assets versus current liabilities. If we have 10,000 shillings in cash and 5,000 shillings of receivables from patients that are due, our current assets are 15,000. If we have 2,500 of accounts payable that we owe to suppliers and 5,000 of compensation due our employees, our current liabilities are 7,500. And therefore, our current ratio of current assets to current liabilities is 2-to-1. This means we have 2 shillings of current assets for every 1 shilling we owe others in the short term. So current ratios below 2-to-1 are signs of short-term distress and risk in an institution. So don't panic if that current ratio for your institution is below 2-to-1. Perhaps that's historically been a situation that you found a way to survive around. But these ratios can be quite useful in very quickly understanding the health of an institution. Now, the third financial statement that we're going to talk about is called the cash flow statement. And the cash flow statement summarizes the sources and uses of cash. So without cash, the institution often ceases operations. It's unable to operate. So even if liabilities are greater than assets from the balance sheet, cash often allows the institution to keep running. And we have cash flow from operating activities. So we get cash from our customers. They hand us money when we provide them services. We get cash that goes out the door when we have to pay employees. And therefore, there's some sort of net cash flow from operations. There's cash from investing activities. So we might have to go buy a piece of equipment. In this case, the example is a piece of equipment that costs 5,000 shillings. And that's a negative cash flow. But sometimes we may have other investing activities that we might be paid. So we might have a building that we rent out to others and they pay their rent, and that might give us additions to our cash flow. There's cash flow from financing activities. So, there's capital that's been contributed to the organization through donations and other things over time. There are things that are drawing on the capital of the business. There are loans that we take out and we get some cash from those loans, but then there's payments we have to make, and those have to go back out the door ultimately as well. So for a given period of time, we often like to look at the net increase or decrease in cash. And so, there's seasonality that occurs in some businesses and certainly in some clinics. Recently, I've heard a story of a case in Africa where, during the harvest, cash flows at a hospital tend to increase because the patient population can afford to pay for care. Care goes up and the hospital tends to have positive cash flows. In the spring, when crops are being planted, perhaps, or in planting seasons in general, there can be a reduction in cash because people in the community just don't have the cash ultimately. So cash flow is very important, and I trust that most of the audience that's hearing this is clearly in the world that understands that when the cash flow is down, stress is usually quite high on the people in the institution. So to summarize, the income statement tells managers and the stakeholders what's the relationship between revenues and expenses. Over a long period of time, revenues have to be greater than expenses, otherwise the institution can't ultimately survive. But because revenues and expenses can have different time periods, so for example, I might have to buy a piece of equipment that's expensive up front, but I get to use it to generate revenues for a longer period of time, the accounting factors of amortization and depreciation and other things make the income statement a tool that helps us assess the health after accounting adjustments. The balance sheet reflects the strength of the institution overall, and equity should be growing over a significant period of time for an institution to be quote unquote healthy. And so it's really important that sustainability shows a growth in equity. And so over time, an institution is hoping to grow its equity. Even small amounts year over year are positive. The cash flow statement is really the indication of the short-term health of the institution. So, can we pay our cash obligations and make our investments and our financial plans accordingly? And all institutions go through periods of time where they have more or less cash, and the severity of the shortages are generally what impact not-for-profit institutions. And it's an important skill, and maybe the most important skill of management is to be very creative in managing the cash flows. Sometimes we have to manage the cash flows by delaying paying our employees, but that means we're really financing the care for our patients on the back of our employees, and so that's a tool we hope to use less as time goes on ultimately. So these three financial statements are very important to managers of a business or managers of any institution. They're important in our personal financial management or household financial management as well. But it's important that we as stakeholders understand how to interpret them, to understand what they're telling us, and then use them to inform our decision making, which is really what financial management is all about.